There are numbers on your paycheck that your employer is hoping you never question, and one of them might be taking more money from you than the law requires. Most people glance at their pay stub, see the direct deposit amount, and move on. But buried in those rows of numbers are deductions, withholdings, and codes that could be quietly draining your paycheck every single pay period, and you'd never even know it unless you knew exactly what to look for. By the end of this video, you're going to know how to read every single line on your pay stub, what each number actually means, how to spot errors before they cost you hundreds or even thousands of dollars, and what to do if something looks wrong. This is the financial skill nobody taught you in school, and it's one of the most valuable things you can learn. Let's get into it. The first thing most people notice on a pay stub is the gross pay, and most people think that's what they earned. And technically, yes, it is. But here's what's interesting. Gross pay is actually just the starting line, not the finish line. Your gross pay is the total amount your employer agreed to pay you before anything is taken out. If you're salaried, this is your annual salary divided by the number of pay periods in a year. If you're hourly, it's your hourly rate multiplied by the hours you worked. Now here's where people make their first mistake. They never check whether this number is actually correct. If you're hourly, you need to verify that every hour you worked was recorded. Missed punches, rounding errors, or scheduling mistakes can shave hours off your paycheck without anyone catching it. If you're salaried, check that your rate matches what was in your offer letter or your most recent raise documentation. Employers make payroll mistakes more often than you'd think. Not always intentionally, but the result is the same. You get paid less than you earned. Always start by confirming your gross pay is right, because every other number on your pay stub flows from this one. And speaking of numbers that flow from gross pay, the next section is where things get really interesting, because this is where the government takes its cut, and not everyone realizes just how many different hands are reaching into your paycheck at once. Now let's talk about taxes, specifically the ones that are required by law and that you have zero say in. These are called mandatory withholdings, and they show up on every pay stub for almost every American worker. First, there's federal income tax. This is withheld based on the information you provided on your W-4 form, the form you filled out when you got hired. The amount withheld depends on how you filled it out, your filing status, whether you claimed dependents, and whether you requested any additional withholding. Next is Social Security tax. This is a flat 6.2% of your gross wages, up to a certain income cap that changes each year. Your employer matches this amount, meaning they also pay 6.2% on your behalf. Then there's Medicare tax. That's 1.45% of your gross wages, with no income cap. These two together are often called FICA taxes. Finally, depending on where you live, you may also see state income tax, local income tax, or city tax withheld. Now here's the mistake that costs people the most money. They never go back and check that their W-4 is still accurate. Life changes. You get married, have a kid, buy a house, start a side business. And if your W-4 doesn't reflect those changes, you could be over-withholding and giving the government an interest-free loan all year long. Or worse, under-withholding and getting hit with a surprise tax bill in April. Either way, you lose. So once you understand the mandatory taxes, the next thing you need to look at is the stuff your employer is taking out that isn't the government. And this is where some of the sneakiest errors hide. Beyond taxes, your pay stub likely shows a whole second category of deductions, the ones tied to your benefits. This includes things like your health insurance premium, dental, vision, life insurance, and any contributions you're making to a retirement account like a 401k or 403b. These are often called voluntary deductions, but here's the thing. Even though you agreed to them, that doesn't mean they're always being calculated correctly. One of the most common errors is having the wrong benefit tier applied. For example, maybe you enrolled in employee-only health coverage, but the deduction on your pay stub shows the employee plus spouse rate. That difference could be $30, $50, even $100 per paycheck. Multiplied by 26 pay periods, that's serious money. Another common issue. You changed your 401k contribution percentage during open enrollment, but the old percentage is still being used. Or you dropped a benefit, like a gym membership reimbursement or a voluntary life insurance policy, but the deduction never stopped. These things happen in HR departments all the time. The fix is simple but requires you to actually check. Pull up your benefits enrollment confirmation. Compare every deduction to what you signed up for, and flag anything that doesn't match. And once you've got the deductions squared away, there's one more category that trips people up the most, and it has to do with the difference between what you see on paper and what you actually take home. This one surprises a lot of people, but understanding the difference between your gross pay, your taxable income, and your net pay is actually crucial for understanding why your check is the amount it is. Here's how it works. Some of your deductions, like your health insurance premiums and traditional 401k contributions, are taken out before taxes are calculated. These are called pre-tax deductions, and they actually reduce your taxable income. That's a good thing. It means you pay taxes on a smaller number, which lowers your tax bill. Other deductions, like Roth 401k contributions, certain voluntary benefits, or wage garnishments, come out after taxes. These are called post-tax deductions. They don't reduce your taxable income. So when you're looking at your pay stub and trying to figure out why your net pay seems lower than expected, you need to trace the math. Start with gross pay. Subtract pre-tax deductions to get taxable income. Apply your tax withholdings. Then subtract post-tax deductions. What's left is your net pay, the actual amount deposited in your bank. If this math doesn't add up on your stub, that's a red flag. And there's one specific line item that people almost never check, but absolutely should, and we're getting to that next. Let's talk about something called imputed income, because this is the line on your pay stub that most people have never heard of, and almost nobody questions. Imputed income is the value of certain non-cash benefits your employer provides that the IRS considers taxable. The most common example: if your employer provides life insurance coverage over $50,000, the value of the coverage above that threshold is considered taxable income by the IRS, even though you never actually received any money. It gets added to your gross income for tax purposes, which means you're paying taxes on it. Another example is if you cover a domestic partner on your health insurance. In many cases, that benefit value is treated as taxable income. Now, this isn't necessarily an error, it's the law, but employees often see this line and think it's a mistake, when it's not. The real issue comes when it's calculated incorrectly. If the wrong coverage amount is being used to calculate imputed income, you could be overtaxed. It's worth asking your HR or payroll department to explain exactly how this line is calculated. And while you're having that conversation, you should also ask about something that can work very much in your favor, because the next section is about one of the biggest opportunities hiding in your pay stub that most employees never take advantage of. Here's something that can genuinely change your financial situation, and it's already on your pay stub. Look for any line that says employer contribution, employer match, or HSA contribution. These are the benefits your company is funding on your behalf, and a shocking number of employees either don't have them set up correctly or aren't taking full advantage of them. The 401k match is the big one. If your employer matches your contributions up to, say, 3% of your salary, and you're only contributing 1%, you are leaving free money on the table. That match doesn't carry over, you don't get it back, it's just gone. Your pay stub will usually show your contribution amount, and sometimes it will show the employer match separately. If you don't see a match line and your employer offers one, call HR immediately, because something may not be set up correctly. Similarly, if your employer contributes to a health savings account or HSA on your behalf, that should show up as well. Check that the contribution amount matches what was promised during open enrollment. These employer contributions are part of your total compensation. They are money you earned, you just have to make sure you're actually getting them. And now that you know how to read all the key parts of your pay stub, the last thing we need to cover is the most important: what to actually do when you find a mistake, because finding it is only half the battle. Okay, so you've gone through your pay stub line by line, and something looks wrong. Maybe the hours don't match, maybe a deduction is too high, maybe an employer match is missing. What do? Step 1. Document everything. Screenshot your pay stub. Pull your timesheets. Grab your benefits enrollment confirmation. Write down exactly what you believe the error is and what the correct number should be. Step 2. Contact payroll or HR in writing. Not verbally, in writing. Email is best. This creates a paper trail. Be specific. State the pay period, the line in question, the amount shown, and the amount you believe is correct. Step 3. Follow up. Payroll departments are busy, and mistakes don't always get corrected on the first cycle. If you don't see the correction on your next check, follow up again. If the error involved back pay, meaning you are underpaid and they owe you money from previous periods, make sure to ask about that specifically, because it doesn't automatically get corrected unless you ask. And if you're getting nowhere, you have legal options. The Department of Labor handles wage and hour complaints for free. State labor boards handle state-specific issues. You don't have to just accept a payroll error. You have rights. Here's the bottom line. Your pay stub is a document full of numbers that directly impact your financial life, and most people never look at it closely enough to catch the mistakes. You now know what gross pay is and why you need to verify it. You know the difference between mandatory and voluntary deductions. You understand pre-tax versus post-tax, imputed income, employer contributions, and what to do when something is wrong. Check your pay stub this week. Not next week, this week. Compare your deductions to your benefits enrollment. Double-check your W-4 if anything in your life has changed. Make sure you're getting your full employer match. This stuff takes maybe 20 minutes, and it could save you hundreds or thousands of dollars. If this video helped you, please hit the like button. It genuinely helps this channel reach more people who need this information. Subscribe if you want more videos like this, and drop a comment below. Have you ever found an error on your pay stub? What was it? I read every single comment, and I'd love to hear your story.